Hello students, this is Dr. Mercado speaking. Welcome back to Accounting 2401, Principles of Financial Accounting. And in this lecture, we are going to begin covering Chapter 5, which deals with accounting for retail businesses, okay? The specific exercise that we're going to be covering in this lecture is Exercise 517. Now, before I begin with Exercise 517, I do want to warn students that this chapter contains a lot of information. Okay, it is one of those chapters that is overloaded with content. I really want to ask students to please read the information carefully, analyze all of the different examples provided. If needed, read it twice before you begin working on your assignments. You do not read the chapter, you are going to be lost. Okay. In this particular chapter, we are transitioning from a service business. We covered service businesses in chapters 1 through 4, the entire accounting cycle. Now, chapter 5 deals with retail businesses. So we're going to see some differences between how we account for things when we provide a service rather than when we sell a product. Okay, and that is what our focus is going to be today. Okay, we're going to be accounting for different transactions where we're actually selling goods rather than providing a service. Okay, so just remember to please read. After you read, I encourage students to, before you begin working on your homework, you get your quiz out of the way. Those are multiple choice questions. You get those out of the way and then you begin working on your homework. 2 attempts are provided and I keep the highest grade. Okay, so let's begin with a really short overview. In this particular chapter, like I stated, we are going to be dealing with retail businesses, okay? The operating cycle of a retail business is very simple. We have to begin with cash, okay? We need cash so we can buy merchandise, okay? So we get our money, we buy merchandise, we sell our merchandise, okay? Some of that merchandise is sold for cash, which is awesome. Others we sell on account. They're going to pay us at a later point in time. After we sell our goods, we need to collect the money, okay? Any receivables that we have, we collect. Any cash sales that we have, we collect the money. We have money once again, and the cycle begins again. You need to have cash to be able to purchase merchandise, to be able to sell that merchandise, collect the money, and the cycle just keeps on going, okay? In this particular chapter, like I said, our goal is to become familiar with the transactions dealing with retail businesses, okay? In our prior chapters 1 through 4, the revenue activities associated with the service business involve providing a service to customers. These are the kind of businesses where they cut hair, your banks provide a service, your doctors, your accountants, your lawyers, they provide a service. Those people that fix your AC units, all of those, they provide a service to you, okay? On the income statement, the revenues were reported as fees earned, okay? We provided a service, we collected some kind of fee, okay? The operating expenses incurred in providing the services are subtracted from the fees earned to arrive at our operating income. Now, in this chapter, we're dealing with retail businesses, okay? Retail businesses involve the buying and selling of merchandise, okay? So, a retail business must first buy merchandise to be able to sell to its customers, okay? When the merchandise is sold, the revenue is reported as sales, okay? And the cost associated with buying those goods is recognized as an expense. Okay, that expense is known as our cost of goods sold. So what happens? We buy our merchandise. Let's say we're going to be selling caps. Okay, we buy our caps for $5. That is my cost of goods sold. Okay, I'm going to sell my cap for $10. Okay, when I sell my cap, I'm going to record the sale as a $10 item. It cost me $5. The difference between the sales and the cost of goods sold is your gross profit. Okay, so I bought the cap for $5, I sold it for $10, I made a gross profit of $5. Okay, the gross profit is calculated before deducting any operating expenses. Okay, the operating expenses are subtracted from the gross profit to arrive at the operating income. So let's say, once again, this example, we buy the caps at $5, we mark them up and we sell them at $10. we're going to get a gross profit of $5. From that gross profit, we still need to deduct any operating expenses, such as like the rent that you have to incur for your building or your utilities, whatever that case, okay? Merchandise on hand that has not been sold at the end of an accounting period needs to be recognized as your current inventory or merchandise inventory. Basically, your inventory is a current asset on your balance sheet. So inventory is a current asset, cost of goods sold is an expense, sales is a revenue account. Okay? These are new accounts that are being introduced in Chapter 5. It is very important that you become familiar with the new accounts. Now, in this particular chapter, when we cover chapters 1 through 4, we build ourselves up to the entire accounting cycle. It took us 4 chapters to cover it. Here, what they're doing is they're transitioning into retail business, and they basically dumped everything into one chapter, knowing that you are already familiar with the process. Okay, the process has not changed. Okay, the only thing that has changed is we have included some new additional accounts that we need to use, but the process of recording your transactions, preparing your trial balance, doing your adjusting entries, preparing any closing entries, preparing your financial statements, all stays the same. Okay, it's just that different accounts are being introduced. Okay, so please make sure that you read before you try out any of your homework problems. So now we're going to jump out to exercise 517. Now this problem deals with customer returns and refunds. Okay. Now what I've done is I've selected a couple of problems that either didn't have a show me how video or that were important or were difficult. Okay. For example, this exercise 517 does not have a video associated with it. Okay. So I wanted to cover it. Most of your problems have a show me how video in Cengage. Please make sure that on top of reading, you listen to those videos. You closely pay attention as to what is happening. Okay, those videos are going to guide you to help you complete your assignment. Okay, so this problem reads: on December the 28th, 20Y3, Silverman Enterprise sold $18,500 of merchandise to Beasley Company with terms net 30. The cost of the goods sold was $11,200. On December the 31st, 20Y3, Silverman prepared its adjusting entry, yearly financial statements, and closing entries. On January the 3rd, 20Y4, Silverman Enterprise issued Beasley Company a credit memo for the returned merchandise. The invoice amount of the returned merchandise was $4,000, and the merchandise originally cost Silverman Enterprises $2,350. And we have 3 requirements in this problem. Okay, so the first requirement, let's tackle one at a time. It says journalize the entries by Silverman Enterprises to record the December 28th sale. Okay, so let's do that one first. Okay, let's do one at a time because if not, we're going to get confused. Okay, so they're asking us to record the entry as of December the 28th. Okay. So what happened on December the 28th? It says here that Silverman sold $18,500 of merchandise that had cost them $11,200. Okay, so we sold them for $18,500. We bought them for $11,200. Okay, so the first entry is to record that sale. Okay, so Silverman Enterprise sold $18,500 of merchandise with terms net 30. Okay, it doesn't say that they paid us. It just says that we sold the goods. What else does it say? Journalize the entries. Okay, so Silverman Enterprise sold $18,500 of merchandise with terms net 30. What does that mean? That means that they have 30 days to pay us the money. Okay, there will be no discount issued. Just means within 30 days I need to have my money paid for. Okay, we need to collect those $18,500 within those 30 days. So basically we're selling to Silverman on account. The terms are net 30. Silverman Enterprises needs to collect from Beasley within the 30-day time period. Okay, so we, Silverman Enterprises, sold to Beasley Company $18,500, and Beasley Company has 30 days to pay us back. So what do we have to do if we sold something on account? Okay, we sold something, we sold some goods, but we have not received payment for them yet. So if we have not received payment for something, we always set up a receivable. Okay, we're going to set up a receivable for Beasley Company. Okay, so how much does Beasley owe us? Well, Beasley owes us $18,500. That is the amount of the sale. Okay, now the sale has been done. Beasley has taken the goods. We've made the sale. So now we have to record an entry to sales. Okay, because we need to recognize the income. We've sold the goods, we're just pending to collect the money, but the sale has been made. So sales will be credited $18,500. Okay, remember, accounts receivable is an asset, sales is a revenue account. Okay, so the first entry here recognizes that a sale was made, and it also puts into our book that we are pending to collect money from Beasley. Okay, that way we don't forget. Now on top of that, we also have to update our inventory. Okay, inventory are the goods that we have that we're gonna sell. We usually have this in a warehouse. Okay, so what happened after this sale? Well, I sold goods, so that means that I must have gotten to my warehouse and I must have taken out of my warehouse $18,500 worth of merchandise. So if I took out $18,500 of merchandise from my warehouse, do I have more or less inventory? Okay, we should have less inventory because we just sold some of that and we sent it to Beasley. So your inventory has to decrease. Okay, the inventory is going to have to decrease. Now, inventory is an asset account. Okay, so the way we decrease our inventory or an asset account is by crediting it. Okay, so our inventory is going to be credited because the amount of goods that we have in the warehouse has decreased. I'm sorry, I put sales when it should be inventory. Okay, the inventory is decreasing, therefore I am going to credit my account. Now when you record this entry, it has to be for the amount that you paid for the goods. Okay, we paid, the cost of those goods were $11,200 and we sold them for $18,500. When we update our inventory, we have to update it at the cost. How much did we pay for those goods? Well, for those goods, we paid $11,200. Okay, so my inventory is going to decrease. Now my expenses is going to increase. Okay, we have our cost of goods sold. Okay, this means that we're going to expense the amount of goods that we just sold. It's an expense to us. This is how much we had to pay in order for us to be able to receive the goods so we can be able to resell them. Okay, my cost of goods sold is an expense account. Expense accounts always have a normal balance of a debit for the amount of $11,200. Okay, that is the first entry. So whenever you sell anything, you're going to have two entries associated. One of them, you're going to record the sale, and then the other one is you're going to update your inventory and your expense accounts. Okay, so you will always have two entries when you make a sale. Okay, letter B. Letter B. Okay. It says, journalize the entries by Silverman Enterprises to record the merchandise returned by Beasley Company on January the 3rd. Okay, so it says here that on December the 31st, Silverman prepared its adjusting entries, financial statements, and closing entries. Okay, now we get to January the 3rd. On January the 3rd, Silverman Enterprises issued Beasley Company a credit memo for returned merchandise. Okay, the invoice amount of the returned merchandise was $4,000, and the merchandise originally cost Silverman Enterprises $2,350. Okay, so we made a sale and then the customer returned $4,000 worth of stuff back to us for whatever reason. Now we have to journalize the entry for that return. Okay. Now, there's a small section. Well, there's a section on your book that covers customers' returns, refunds, and allowances. Please go over that section. But basically, I just wanted to highlight this information. Okay. Sellers are required to estimate customer returns, refunds, and allowances at the end of the accounting period. So at the end of every accounting period, we have to estimate how much is going to get returned, how much refunds are we going to have to issue, and how many allowances are there going to be made during the period. These are estimates based on like history, trends, stuff like that. Okay. Based upon these estimates, 2 adjusting entries are recorded. So every accounting period, we have to estimate how much of it is going to be returned, how much refunds and allowances are we going to issue. Okay. Now the first adjusting entry debits sales and credits customer refunds payable. So all we're basically doing is we're putting money aside. So for when we have to process a refund, we already have money set aside for those refunds based on those estimates. Okay. So that is the first adjusting entry. The second adjusting entry debits estimated returns inventory and credits cost of goods sold for the merchandise that is expected to be returned. Okay. Now these are entries that are done during the end of the accounting period. That way, if a return comes in or a refund comes in, we already have money set aside for those returns or refunds. Okay. So let's do letter B. Journalize the entries by Silverman Enterprises to record the merchandise returned by Bisley. Okay. So Bisley returned $4,000 worth of merchandise to us. Okay. So we need to process that adjustment to Bisley. Okay. Bisley no longer owes me $4,000. Okay. So where am I going to get the money from? Well, at the end of the accounting period, we put money aside. Okay. The first entry debits sales and credits customer refunds payable. So we put money into the customer refunds payable. Now that we actually have a refund, we are going to take money out of the customer refunds payable account. When we put money in, we credit the account. When we take money out, we debit the account. Okay. So because we are taking money out to refund Bisley, we're going to go ahead and debit the account. This is happening as of January the 3rd. Okay. And let me just insert, shift cells down, and this is effective 20Y4. Okay. So as of January the 3rd, we made a return. So what are we doing? We're taking money out of the customer refunds payable. Okay. For $4,000, that is the amount of the return. Okay. And what am I doing with that money? I'm going to give it back to Bisley. Now remember, Bisley hadn't paid us yet. But because he hadn't paid us yet, we still had a receivable set up. So Bisley owed me $18,500. So what I'm going to do is I'm going to go ahead and I'm going to offset that return with the receivable. That way when Bisley pays me, he'll just pay me the $18,500 less the return of $4,000, which would be the difference. Okay. So because the customer hadn't paid us, we had a receivable set up for them. When we make this return, we're going to go ahead and we're going to credit back the receivable. If they would have paid us cash, then we could just cut them a check. Okay. But that's not the case here. They didn't pay us cash. They had a receivable. So we're going to go ahead and we're going to give credit to that receivable. Okay. Okay. Now, the customer returned merchandise. So now we, Silverman Enterprises, have received those $4,000 of inventory. So what are we going to do with that inventory? Do we have more or less inventory? Well, now we, Silverman Enterprises, have more inventory that I'm going to put back into my warehouse. So I have to update my inventory account to reflect the new amount of inventory that I have. Okay? So I'm going to go ahead and I'm going to debit my inventory because I'm going to increase my inventory. Now we're going to increase it by the amount of the cost. It says the invoice amount returned was $4,000. The cost to Silverman Enterprises was $2,350. Whenever we record any entries to the inventory or to cost of goods sold is at the cost. Okay? So my inventory is going to increase by the cost of $2,350. Okay? And I'm going to go ahead and I'm going to credit my estimated returns inventory account. Okay. Okay, that look at the what we read here. The first adjusting entry debits sales and credits customer refunds payable. So basically they're putting money aside for those returns. Whenever we have a return, we take money out of customer refunds payable, which is what we did here. Okay? Now, the second part, the second adjusting entry debits estimated returns inventory. Okay, we debit it and credits cost of goods sold. Now, because we are doing the return, we're going to do the opposite. We're going to go ahead and credit estimated returns inventory, okay, for the 2,350. Okay. This is going to update my estimated returns inventory value based on that, taking into account that actual return that took place, okay. So that is happening on the 3rd. Now, letter C says, letter C is happening as of January the 7th. It says journalize the entry to record the receipt of the amount due by Bisley. Okay, so let's look at what happened with Bisley. Okay, Bisley purchased $18,500 of goods. Then Bisley returned $4,000. So that means Bisley owes us $14,500. Okay, and if Bisley is paying, what are we receiving? We are receiving cash. Cash of $14,500. Okay. Now, because Beasley is paying the balance due, now we're going to clear the receivable. Okay. Beasley owes $14,500. Remember, look at the accounts receivable right here. We have a debit of $14,500, and then we have a credit of $14,500. So that means that we have a debit and a credit. 18,500 minus 4,000. The balance is 14,500. That is how much is owed from Bisley Company. Okay, so that is the amount of the entry that we're doing to clear out the receivable of 14,500. Okay, so we have a lot of information provided in this problem. We've got a sale, we've got a return, and then we've got a payment. Okay, please read the information carefully. Remember that estimates are done. We basically set money aside based on what happened prior periods, and we can estimate, okay, how much do we think we're going to have in returns this month, or how much do you think we're going to have in refunds this month? Okay, and then you make the necessary entries. Okay, so this is what we have for exercise 517. Please read carefully. And if you have questions, please do not hesitate to reach out to me during my scheduled office hours. Okay, so that is basically it. Until next time, have a wonderful day.